So I think what most people care about is the main event, which is a pause in the increasing of interest rates. I don't think we all expect that there's going to be a pivot and we're going to start decreasing interest rates all of a sudden, unless there's some huge, credit-like trigger. But let's talk about the pause, because I saw a few people throughout the possibility that this could be the last interest rate hike, just because the next meeting is in February 1st. So we have, 6 more weeks of data and time to go on before that next meeting. And that if that thing declines even more, does that count as considerable, significant, consistent evidence that we are going back down to 2%?
Welcome, everybody, to the Alfalfa podcast. Let's get a cheers. I think we need a Steven birthday cheers.
Thank you.
Happy birthday, Steven.
Oops.
Really juicing that birthday, aren't you?
Ooh, Nick's drinking a Pellegrino.
Yeah, that's a faux pas on
My
this
birthday
podcast.
wasn't that juiced. I didn't even invite you all out for like a. Is it, you?
Just, it's my notes. Put it up on a stand.
I had one party.
There we go.
Yeah. Some people do a party and then they're like, oh, actually, it's my real birthday. Now I need 24 of you to come out to dinner. I know that because I used to do that.
Yes.
There's like some contagion going on because it was also like David Hoffman's birthday, so we were like celebrating a lot over the weekend.
Can we do another cheers?
Cheers to Hoffman's birthday.
That, and can we also cheers to SBF and chains?
Oh, yeah.
Yeah.
Yes.
Yeah, baby.
Finally. It makes me a little less worried about humanity that he's actually like, okay, they got him.
Well, there's a new
At least
conspiracy
arrested him.
now that he was arrested so that he could avoid incriminating himself on Capitol Hill. So you can't
Because it was
win.
getting so bad.
You can't win, really. Like, oh, how convenient. He was arrested right before he was supposed to testify. Yeah. I think actually a congressman got up and was like saying that. I forgot who it was, but
Probably a Republican.
He was pushing to. I mean, not going to lie, it's probably true.
But he didn't have to testify on that one, right? That was like voluntary.
No, he was called to testify, I believe.
And that would have been,
They dropped the indictment
wow.
the day before.
Well, I think being in jail's worse. Like, is like
Being
Bahamas
in a
jail probably like
Bahamian jail. I saw some pictures on Twitter of the jail. It didn't look good.
doesn't sound good.
Looked bad. They said there was a quote unquote overcrowding problem.
Yeah, I would take rich guy U.S. jail over Bahamanian all day.
Yeah, he should have just came home and just, I don't know, went to the beach or something and just gotten arrested there and in L.A. and just, it seems better than just going to Bahamian prison. But
Right.
I don't know, suboptimal.
So before we get started here, we got some good feedback on last week's money episode. That was
fun.
I forget what we titled it, but I think it was like the best casino in town, decentralized perps.
That sounds
So-
like a title we would use, yeah.
Yeah. So
We would use, Steven? I never get credit. There's no credit here. Never. The contrarian
We should
again.
just
Rodney
rename this
Dangerfield.
the Armand,
No respect.
the Armand podcast.
Zero respect. I wouldn't listen to that pod.
But keep the feedback coming in the Discord. We heard some good feedback on that one and the AI one.
That was a really fun one.
Yep. Just a reminder, we did talk about GMX, DYDX. If you want to use the referral link, it's in the show notes. I think you get 5% discount off trading fees. So check it out and also keep the feedback coming. Appreciate it,
Yeah.
guys.
Yeah.
All right, cool. Is it alfalfa time?
It is.
Bam. Who wants to go first? Me? All right, fine. I'll go first.
Someone's an eager beaver.
The Steven podcast.
I took money off of crypto today, and I'm sending it to my bank account, and I'm putting it in a real brokerage account.
Is it a first timer?
I used to have a brokerage account. Still do, I think. I actually should check if it's still open. Good old Interactive Brokers. But I'm planning on buying real financial assets, actually.
What are you interested in? T-bills?
I am going to
CDs?
go long TLT, and I'm going to buy some S&P probably June 30 puts, I think.
TLT's the 20-year bond, government bond. Is that right? Or is it
it's
the
like
short
it's
version?
it's long duration.
And it's the long version.
Yeah,
it's not the
long.
inverse. Okay.
Absolutely wrecked this year. I think it's a good play for reasons I think we're going to touch on later as well, because I think when we head into recessionary times, that's going to be a good play. Also, I think there's a risk that we do a double dip inflation thing next year, which would suck if you were, in shorter term bonds. But I don't think like the longer end of the curve is going to react to like an inflation spike like that might happen. But yeah, I'm pretty excited to buy some puts. I was kind of hoping the market didn't tank too much today.
We had a little rebound towards the end of the day. I mean, it totally reversed. It totally reversed intraday and then kind of came back.
Yeah, so today's Wednesday, December 14th, FOMC day. And I sold off some puts off that post press conference dip. I got rid of some of the shorter expirations, but I did leave the June expiration.
Oh, you had some Junes already.
Yeah.
Look at you.
So I left that one, and it's in cash. Rest of it's in cash. We'll see.
Even those short duration, juicy, like you can get like 4.7% on like a 6 month, can't you?
Oh,
or
yeah.
a 1 year
some
maybe.
Of the corporate treasury, yeah, we have some CDs.
Who's buying stocks when you can get 4.7% in a 1 year government bond?
New Chicken Town, Terra.
Terra. Anyway, yeah. What are you up to?
I made a lot of moves in TradFi, but what I wanted to talk about on this Alfalfa round is something completely different. After our 1 week long bender, I caught a bit of a cold. I felt just completely depleted of energy, like my personal resources. And I am now, before you, committing to a 1 week long dopamine fast where I feel like I can recover and get back to a baseline normalcy. I think in our separate friend chat, somebody was making fun of us for saying like, yeah, we'll do a dopamine fast, but then once it turned out like you can't drink on the dopamine fast, then we're all out. Like I'm actually in probably January 1st, so I can get like that. It's kind of like a free day. I'll be hungover, but like that's a free day, and then go to January 7th. And anyone in the Discord, let me know what you think is like a reasonable dopamine fast. I still have to use the computer to work, but I'll get off social media. I will not use my electronic devices for anything other than work. I think is like a reasonable expectation.
Okay.
And then it will also be like health focused. I'm gonna work out every day, maybe several times a day. Diet, just try to get right.
No free dopamine.
No free.
You and Jocko might end up be best buds.
He's gonna put me in a headlock.
First time he sees you.
We should do that. We should do the first annual Alfalfa New Year's dopamine fast.
Yeah, there has to
Get
be
the audience involved too.
Some constraints.
I need a break. I feel like a train wreck right now.
Like some people go to the woods. I still have to like do work and stuff. Like so, I'll be on the computer.
We're not gonna go level 3. We'll go like maybe level 2, maybe level 1.5. We'll figure it out. I'll relook up the levels. I'll tell you what you can do.
I'm down.
Hell yeah.
Yeah.
Hell yeah.
I think I was the only one that was down. You guys all backed out because of the alcohol thing.
Oh yeah.
No.
Well, that was me for sure.
No. I was the one who reminded everybody that there was an alcohol thing. I
Right.
was like, oh yeah, this is the thing.
Yeah.
I've
no
been
one
on.
else was
I've been
down.
on board this. I've done this.
Have you been
multiple
on
times. Yeah. He's gaslighting me. I know your gaslighting face.
No.
There's
no face.
You have an actual gaslighting
It's a poker face. You'll never know. Just play different faces.
Sideways smirk.
I don't know. You're the king of gaslighting.
Okay.
Pickleball chat proves that you're the king of gaslighting.
I'm going to avoid making eye
can't
contact
even-
with Armand right now because I cannot.
Okay, I gotta volunteer into this dopamine fast because as you guys were talking, I realized I couldn't find my phone and I had an instant sweat breakout that it wasn't near me, even though I have my laptop.
You're not even drinking.
in front of me. Not even drinking. Anyway, I'm in.
Caffeine's off the table.
Sure. I mean, I don't know. Dopamine. We're talking health. I'm confused. Social media.
Yeah.
It's all over the place.
Just
I need to understand the parameters.
New year, new him.
Well, yeah, I don't even understand the parameters. Like I
what
just
is-
learned about dopamine from you guys on an episode 3 weeks ago.
Yeah. All right. Well, maybe Steven, since you have experience, you can lay out the parameters.
I will be your show.
In the Discord.
your
In the
Tell
Discord,
us
please.
what to do, and
Yes,
you can
of
put it in the
course.
Discord, and everyone else can join us that wants to as well.
Okay.
Kick off the year.
I like that. Let's
Yeah.
do it. Did we do all the alfalfa?
No,
Is that-
Armand.
Armand.
Did you go?
I did.
I don't really have anything. Just sold one more cock punch.
Nice.
Bought one more at the bottom that we just had at like
Damn, you're
0.6.
buying cock punches?
you're
I mean, they're
cock
back up
punch
to one
speculator, huh?
ETH. Yeah, I'm just playing around with it.
Did
for
you
sure.
listen to the first podcast episode? I did.
Oh no, no.
It's a 5-minute episode.
I
Oh,
don't-
really?
Yeah, it's already out there.
Okay.
It's
I
released.
like no disrespect to the project, but that is like
Oh, you're-
that, I just
you're in
care
it-
zero about
You're in
that.
it for the money.
Of course,
He's in it for the
of
awesome
course.
art,
Who isn't?
the top-notch art.
Art's.
The art is amazing.
You're disappointed with the art. I see it in your face.
Show me someone who likes the art.
I think the art is
It's okay. It's just like
Yeah, it's like a
it doesn't fit together.
It's
As
like
someone
a,
explained.
it's like a 6 out of 10. I've seen way worse. To
sure,
be fair,
sure.
it's like a 2 for what it should have been, given who made it and how much he shilled the fuck.
Yeah.
out
I've
of it.
never been in this for the art. Never been in this for the fantasy podcast. Never been in this for the emergent long fiction. I'm in this for one reason. His name is Tim Ferriss. That's it.
I was kind of excited about the fiction, to be honest.
No.
It was kind of cool.
Come on.
He's in it
5
for
minutes.
he's in it for the story.
He's building the lore around this world. I was like, I could get involved in this.
You don't spend this kind of money for that. You could listen to the podcast anyway.
Well, I listen to it for free.
So
I'm not an
the
owner.
question becomes exactly like, why do you purchase the NFT? You don't purchase the NFT for the content, the podcast, the fiction. You purchase the NFT to make money. And that's the funny thing about what people that launch these NFT projects come out and say. They go, don't buy this to make money. It's like, fuck you talking about, bro? Like, no one's buying a collect, and then like even saying ridiculous things like buy it like it's a collectible and you're going to put it up on your wall, and then uses the example of like, I put things up on my wall and I never sell them. And it's like, again, nobody does that. No human being is in this space for that reason.
Definitely not. You're definitely not putting anything on your wall that looks like a cock punch.
No.
Like, those are so dumb.
Absolutely not. Like you could, I understand like because of like what a CryptoPunk is, like that could make sense, maybe, or
Yeah.
like a Fidenza, or like some kind of like real art like that, like that's an NFT. But this is completely different. No one's putting this up on a wall.
You got to start somewhere. Maybe someday someone will go into your apartment and be like, "Oh my god, is that a cock punch?"
You know what bothered me?
Only if a cock punch was worth $1 million.
He did a follow-up interview where he somebody asked him about dick butts, and I don't know if you guys saw this, but he's like, unfortunately, dick butts doesn't have the mimetic desire that cock punch has. And I was like, are you fucking out of your mind?
Yeah.
It does, proving the reason you even know about it. Like, you know how to respond.
Yeah.
Anyway.
Anyway,
Anyway, I am 100% in it for the money.
okay.
And nothing else.
Thank you for admitting that.
Yeah.
I appreciate that.
And I'm making money on it. And
You're
it's
safe
nice.
in the eyes of the SEC for now.
All right. Speaking of making money, should we talk about how to make money?
Yeah, let's do it.
That was a terrible segue. I'm sorry.
I'm not going to say no to this.
I'm into money.
I mean, do you want to talk about Sam like real quick? Should we just acknowledge that he's in jail? Do you want to dunk
can
on
I
Kevin
rattle off
O'Leary
some
real quick?
highlights from-
Oh, there were some good highlights from the yeah. I enjoyed some of the highlights.
All right, here we go. John Ray, FTX CEO, few highlights. FTX uses QuickBooks for their accounting, which probably mixes user deposits and Alameda's funds. That's fucking hilarious. Second quote, this is really just old-fashioned embezzlement.
There you go.
This is just plain old embezzlement, old school. He admitted, or he
So hold on, this is the guy who was hired as CEO after SBF got kind of
Enron.
ousted.
Yeah,
Enron lawyer
yeah.
guy.
He's a former Enron. Like I think took them through bankruptcy, I believe. So he's seen a lot.
Yeah.
done a lot. This is worse. He confirmed that Sam lied when he claimed that on Twitter that they had enough assets to cover customer funds. That tweet was pretty quickly deleted. Let's see. CFTC said that the Bankman-Fried operation was a fraud, quote unquote, from the start, as in they know maybe dating back to 2019 was when the potential fraud started.
They didn't. Aside, didn't they also mention that like ETH was a digital commodity in that statement?
I believe,
they
they mentioned
sure did.
Bitcoin specifically, Ether, and Tether.
Tether. It totally discredits the whole thing when they put Tether in there.
Yeah.
And then the last highlight I'll mention is that there was a public distinction for FTX.com and FTX US, but in reality there was not. And that's unfortunate for all of our US listeners because they might have had funds on FTX.
So the
US.
aggregation of his of what he's arrested for is like 140 years in jail. Like that would be
yeah.
the max penalty.
Yeah, 110 or something.
Okay, yeah, 110.
I think it was 120.
Give him the Madoff treatment.
So how much time do you think he'll actually serve?
10 years.
I'm gonna call over on that.
We should
I'm
do
gonna
it. We
call
should do a
over
betting
on
pool.
Elizabeth Holmes, which was like 11 or 12 years.
over 11.
Yeah.
I think it'll be
Over, under
over.
11.
I kind of feel like he will be made an example of
Well,
now.
what's Madoff in for life?
Well, he died. He died in prison, right?
But he was like, I think
He had no chance of getting out. He submitted a petition to get out because of COVID and his health, and they said no.
But he was in there. He was in there for a long time.
Right.
I think we need to start demanding Kevin O'Leary go to jail at this point. He's really
Okay, so Kevin
grinding
O'Leary's
my gears.
O'Leary's interesting because why is this guy continuing to double down? Like, obviously he's this paid shill, right? A spokesperson, $15 million. But I would feel that this guy could be completely absolved if he just said, no, I'm obligated by contract to support SBF. So here's what I'm going to say. Like, he could just do that instead of putting on this like charade, actually standing for SBF. I don't think he actually believes it.
Or he could say, yeah, I got paid to say nice things, which is why I said nice things. But now that it's proven fraud, they violated their end of the contract. I don't have to say.
I don't think he's
say
gonna,
whatever I want.
He's not getting paid anyways now, right?
At least like
I
slightly
mean, I assume
based.
he's gotten paid. I'm sure some money was due up front.
Yeah, up front, but I don't think those checks are coming in now.
Yeah, I mean, the guy just drips of scum. I mean, like,
This is such
But
a.
the question is, why is he continuing to support and shill when there's no
I think he wants the
incentive?
check.
I think he just follows like the
What
the
checks?
there's like the Trump playbook, right? You just double down, just always double down, no matter how wrong you're. Oh, you were paid $15 million to support a complete financial fraud. Double down.
the Ray Cohn
Would you
model.
do it again? Absolutely.
Well,
I think that's what it is too.
He could be a creditor, to the bankruptcy and submit his application like I'm owed $10 million, and maybe he gets 3 out of it. Who knows? Maybe
Yeah.
that's why.
Anyway, we don't have to linger on this too
Yeah,
much.
screw that guy.
Mr. Wonderful, you're dead to us.
Yeah, that guy sucks.
Yeah,
Fuck you.
Get him off CNBC.
Yeah, he's being
Jesus.
really scummy.
Absolute douche. Anyway, we'll pivot to inflation. The year of the inflation chatter.
Yeah.
Armand, have you been following the events of this week?
A little bit.
Do you want to quick recap of everything?
I would love a recap.
Quick bullet point. Tuesday, CPI print comes in. It is a cold print, like way colder than everybody was expecting. I saw like 2 out of 69 analysts in a particular sample predicted that level or lower. It was a really, really low print. Services like healthcare, surprisingly, just everybody's like, where's all this cheap healthcare? Like, I don't know. People are confused about that. Bob Elliott from former Bridgewater had been tweeting pretty intensely about how wages were going to be the thing that was going to make inflation sticky. Like, if wage growth remained like 7%, right, you're not going to get 2% inflation. Like, maybe that comes down to 6. Maybe inflation comes down 5 or 6 with it. Still think that's a possibility, but I don't think he was expecting this like huge drop off in wages as well. Like, commodity prices have been like totally like goods tanking. So we got a super cold print. The stock market gapped up like big time. And then a funny thing happened. It just straight sold off right from the gap up opens, gave back the entire day's gains.
NASDAQ was up 4.5% at the open.
Yeah.
This is huge.
It was a weird day. Like, initially people celebrating like, yeah, cold inflation, stock market's up. And then we're like, wait, why is the stock market going down? I'm curious your guys' thoughts on that. We can talk about that later. And then today, FOMC, 50 basis point hike. That was not a surprise. What was a surprise, I think, was the presser and the dot plots. The dot plots are where all the Fed governors, put where they think rates are going to be over the next few years on a neat little chart with a bunch of dots on it. Powell was pretty hawkish. I thought the press release was pretty hawkish. The dot plots, like, seemed there were only 2, I think, governors who saw rates being like less than 5 at the end of the year. So I think the market was kind of shocked by that. Actually, there's a bunch of lines in here that stood out to me. But if Powell, we require substantially more evidence of lower inflation was a big one. So he doesn't seem moved. The market did not like that. We sold off more. And now here we are. And I kind of want to comb through the rubble with you guys and figure out, like, what do you have any thoughts?
I want to emphasize one point mentioned. You mentioned the services CPI, and why that was so important is because we already knew that goods, the hard stuff that you buy in the store, were going down and decelerating pretty quickly. And the thing that left over was services like restaurants and hotels and airlines, and that's where kind of like the labor part came in that Stephen mentioned. So before COVID, this was inflating at 2%, kind of target rate. It came in at the 3-month annualized, the last trailing 3 months annualized came in at 3.2%. That's down from the prior 3 months annualized 5.7. So that's a heavy deceleration. And if you're gonna like start
Huge
extrapolating, you might be like, well, is in 1 to 2 months and 3-4 months we're gonna be back down to 2%, which was and by the way, this is a less shelter. So this is excluding the part that we know lags significantly, like rent and owner's equivalent rent. So that one was the one I think deserves emphasis, and that I think what caught most people by surprise if you were kind of,
So is the rent included in headline CPI?
yeah, I mean, everything's included in headline CPI,
Okay.
I believe. And then in services, shelter, like for example, shelter CPI, 8.7%. The prior 3 months, 8.8. So it's basically flat.
Yeah.
But that's because of the rolling of rental leases. It takes 12 months for those to roll off. So that's why that is expected to be lagging. It's designed to be lagging on purpose. So I don't think there's any surprises there. But if you're trying to predict it, you want to look at these these trailing annualized rates to predict out what the year over year is going to be in the future, so you can hopefully front run. So I think that's why the market got really excited. And then, yeah, I was surprised when they said
Super low on services. Do you have any thoughts on why that is so much lower than we anticipated, or so much lower than the previous 3 months even?
I have to believe some of it is noise. It's also possible there's, you put your tinfoil hat on, maybe there's a little funny business going on with like the healthcare numbers were like a really big drag from what I saw. And they were last month as well, but people were citing this kind of one-time seasonal adjustment that's not like a real thing that like put the numbers down. But then, we're down again this month.
So I think what most people care about is the main event, which is a pause in the increasing of interest rates. I don't think we all expect that there's going to be a pivot and we're going to start decreasing interest rates all of a sudden, unless there's some huge, credit-like trigger. But let's talk about the pause, because I saw a few people throughout the possibility that this could be the last interest rate hike, just because the next meeting is in February 1st. So we have, 6 more weeks of data and time to go on before that next meeting. And that if that thing declines even more, does that count as considerable, significant, consistent evidence that we are going back down to 2%? What if that services CPI less shelter 3-month analyzed is at 2%? I mean, it seems like from the presser that's not going to be the case. They're probably going to start raising in 25 basis point things, but we're getting closer to a pause than I expected we would. I think you have to take in the data and be like, okay, I have to rethink how I'm viewing this. I was thinking we might get to like a 6% Fed funds rate next year, but now this data is pretty.
Yeah, like all the voting members are underneath that level.
And I think 2 days before you had, what's the guy, Nicky
Leaks.
Yeah, Nicky Leaks on the Wall Street Journal. He's like, Powell's preferred leaker. He said he had an article talking about how there is a lot of disagreement amongst the Fed presidents and which way they should go. And that was kind of like.
But unanimous support today, and the dot plot was still really hawkish. And I think for the last few months, what's really mattered isn't like, are they going to do 50 and then 25 or 50 or 50? It's like, what are they going to get to eventually? And how long are they going to stay there? Like
Yep.
that's like the big thing. And today, like seeing them like in aggregate, like the higher for longer was higher for longer today. Actually, if you look at where everybody's sort of projecting the terminal rate, it's like slightly
Over 5%.
higher. Yeah, like slightly higher, for slightly longer now than the previous dot plot. And that's in tandem with this supposedly super dovish CPI print. So the market's doing like a little bit of a double take on that, because I know a lot of people thought Powell was going to come out kind of soft today to not spook the markets too much, because things do kind of look soft out there now. And, they're going to be worried a little bit in the back of their heads about like creating some deflationary like credit bust by like being too tight. Too aggressive into like a recession. But yeah, it didn't seem to care today.
March, April pause seems right about, I don't know.
I would not bet on that. But I'm also like taking a step back from like we're getting pretty granular on this inflation thing. I think it's cool that we are. It's important. Like to try to front run this Fed move could be very lucrative. So I think it is important. But like I've never been a macro analyst, right? I've always been like a bottom up guy. Like I'm trying to identify good business models that make money, and that good business models can make money in sort of any environment, and I want to identify those and invest in those. So with that focus, I look at this headline CPI coming at 7.1%. In absolute terms, that's very high. Mm-hmm. And in relative terms, against expectation of 7.3%, I'm like, you want to make a big market move based on 7.1 against 7.3? Like this it doesn't move the needle for me, but I'm not a macro analyst, but like this to me just seems like, hey, we're still in a bear market. This does not remove a bear market. Like inflation's still too high. The Fed is going to continue tightening in any way they can to bring that number down. Maybe the number is slowly moving in the correct direction. So that's the data point that I would take out of it. But like, I'm not ready to like start calling for pause, change. Like, there's no regime change here based on this data at all. I closed my shorts prior to this because I'm not trading the Fed release. I'm trading this bear market. Like my idea is like, we're removing liquidity, we're tightening, so I want to be short risk assets. I'm back short because nothing has changed. This is still a high inflationary environment that they are going to continue tightening on.
I think I'm curious, like what you think of this, but I was thinking a lot about Tuesday and what happened, and I feel like it's going to go down as like a very seminal day. Like you pay attention when the market sort of doesn't react anymore to bearish news on the downside, but then you also sort of pay attention to when it doesn't really react to bullish news on the upside. And, the S&P should have been able to kind of bust through. It's been going through this like big technical magical diagonal line level, in addition to the 200-day moving average, which is a big thing that everybody looks at to see if you're in a bull or you're in a bear. And it rejected pretty hard off of that. And I think it's signaling like a regime change. Like we've been living in this environment for the last year where the market's like, what are interest rates going to be? What is liquidity going to be like? Right. But now I think that it's like the dog finally caught the car and it's like, oh wait, inflation's going down. Wait a minute. Why is inflation is that because the economy's getting worse? And then, if the economy is getting worse, are we going into a recession? Wait, are we already in a recession? Are earnings going to go down? And now everybody's having their like, oh fuck moment. Like, wait, maybe we don't want to be YOLO longing stocks into this environment. And in some ways, I think you can make an argument the stock market's more expensive now at 4,000 in like a 4.5% 10-year. What is the 10-year at? 4.4% than it was at the beginning of the year when the 10-year was like half of that or whatever. Like you are. Like, why would you be buying stocks here when you can get like 4.7% in these like government bonds? So like in some ways the valuations seem even more insane right now. And I'm just like wondering what is the next upward catalyst? Like this was the thing, right? Oh, inflation. And then I guess the next upward catalyst is the pause itself. But it feels like the pause itself now is going to come at a point where it's like, it's very clear there's something very wrong, and you're not going to be wanting to jump into stuff then either. Like by stuff, I mean like risk assets, equities, that sort of thing. What do you guys think about that?
I mean, just to add on, and kind of the same sentiment, we talked about last week how net liquidity still has some catching up, as in it's still trending downward, and the Fed is a little behind on trimming the balance sheet. The Treasury has held up things a bit in terms of where they plan to be by December 31st. They still have to increase their balance quite a bit in order to hit their own target. So S&P was already trailing its net liquidity, kind of equivalent value, and liquidity itself is a little behind the ball in terms of where things were projected to be. So I don't think that's going to change. I don't think they're all of a sudden going to stop QT. So
I mean, they haven't been doing QT, right?
Right.
Like the last couple months, they've been sort of silently inflating liquidity via the Treasury, and it doesn't seem like that is a sustainable thing. That's
There's a
continue.
hard cap on that, right?
Yeah,
Right. I think you nailed it, dude. Bingo. There's this like traditional valuation metric in stocks that is called the Fed model. You can Google this thing. The Fed model, you take the earnings yield on the S&P 500 and compare it to the long Treasury bond. And as that gets closer and closer to even, like, why would you take risk in stocks when you can get a risk-free same yield in treasuries? And to Steven's point, stocks look way overvalued now in a regime where the yield on treasuries is equal. And going even further, like if we go into recession, the earnings, like the earnings part of that yield is going to drop off a cliff. So like it's going to get even uglier and uglier.
Yeah. Just small point of clarification. 10 years at 3.5 right now.
3.5 now? Okay.
And PE ratio.
The 1 year is at 4.5, right? Mm-hmm. Yeah. So, I mean, buying the 1 year sounds great, right? You just park your money somewhere for a year and then you wait out, like crash, collect 4.5%. Maybe that yield even comes down on the 1 year in the meantime because everything gets so bad.
Who cares about the 1 year? The 3 month T-bill is 4.3,
just take the 3
4.4%.
month. Yeah, don't worry about the 1 year.
Yeah. Well, if you could make money, I think, on buying the 1 year and the appreciation of the underlying, I think you could make an argument that would go up.
So you're along the
hold to
long
maturity.
bond, the TLTs, the 20 year.
I like going long the long stuff on like for a speculative trade because I think it will be. I'm still worried about like inflation getting sticky again in Q1 next year. I'm worried about China reopening. I'm worried that oil bottomed and maybe like we have like this double dip run up in energy. Like food is still high. I think I saw food number was still 7-8%. It's be very easy, I think, for energy, like oil energy to spike back up into the double digits.
Definitely.
And like I don't know if you want to hold like short duration stuff unless you're holding it through to maturity in case whatever. But like if we get like a big inflationary spike, that's gonna like hurt the front end of the curve, but you'll be a little safer from that on the back end of the curve.
So in that video,
is
like
how I'm thinking about it.
Nick shared the video from Felix Zulauf. Was that his name? Zulauf, and he was predicting that we have not peaked inflation yet.
Yeah, so just to get a little more granular, he was saying, I see the market kind of continuing to decline because of net liquidity. By the way, you might, Felix Zulauf might sound familiar. We've mentioned the pod before. If you follow Arthur Hayes on Twitter, at Crypto Hayes, he's mentioned Felix Zulauf as
That's daddy.
his macro daddy muse.
I think we mentioned him in like some of the very early Alfalfa episodes because he was very influential in my like. I listened to a pod with him, and it was literally that pod where I had my oh shit moment. Like I was like, oh fuck. Like I heard what he was saying, and I was like, this is going to happen, and I got real scared. That's when I sold a lot. That's when I went short and just sort of like went into panic mode. So yeah, I've been following him for a bit, but he doesn't come out of the woodworks and do pods very often. He's got this like kind of expensive newsletter that you got to be Arthur Hayes, and I don't even know what it costs.
I already emailed you. We're going in on that together. You don't know yet, but
all right.
we're doing that bad boy. So I did a little TLDR for us on his interview because I thought it was
because he's got a sort of thesis for this year and like the next 10 years, like that you want to try to digest as
I
an
want to
investor,
transition
which I
this,
think
but this is a good
super
point of
valuable.
transition about your inflation potentially peaking up again. So basically his thesis, he also believes that the amount of money is maybe more important than the cost of money. Liquidity may be more important than interest rates. Mm-hmm. So he thinks liquidity going down, we could see a bottom in Q1. He thinks that there may be some type of trigger event, like a credit related event. And in particular, he says he thinks it might happen in China. And just we did talk about last week or 2 weeks ago that how I noticed that some of my employees in China noticing that demand was very slow, that factories were closing, that they were extending Chinese New Year because there wasn't enough demand. So I don't know. I connected those two dots pretty quickly that from what I've seen there and what he's mentioning, that there could be a credit issue. He explains that credit issue is important to us because there is something like $3 trillion of US denominated Chinese debt. And if they have trouble meeting those obligations, there are US banks, but maybe European banks possibly in between that could cause some kind of global kind of cascading effect.
Is that because China, they would be selling those treasuries because they have to meet debt obligations? Selling treasuries pushes the rates up on treasuries. Rates higher on treasuries basically make the cost of debt higher for the entire world because that is like the top of the debt pyramid is U.S. treasuries. That's like the gold standard.
Exactly. So he sees an event where central banks have to come in with loosening monetary policy. He thinks in general, 2023 could be a pretty good year, that we might see 9 months-ish of risk assets. Initially, those same like ARC style stocks increasing because of the change in monetary policy, followed on by your typical like maybe value-oriented stocks, specifically commodities and precious metals.
But hold up a sec. He thinks there's going to be a run in risk assets after a credit event, right?
Correct. Sorry.
Yes.
Yeah. So credit event, monetary response, then run up in risk assets, and also a run up in commodities.
Yes.
So he sees this run up happening all the way through 2023, and then end of 2023 into 2024, he sees inflation surging again. And he brings up this important reminder that in the 1970s, this similar thing happened where inflation peaked, we shut it down, and it reared its ugly head back up again. And he says that if you kind of compare it to the 1970s, that first time when inflation shows up, the bond market gets hammered down pretty bad. The second time it shows up, the bond market is going to demand much higher yields for that inflation because the first time it comes around, this is temporary, this is transitory. The second times it come around, they freak out that this could be more permanent, and they want higher yields.
And
they want real yields.
Yeah, I don't know
Real
if my history is not maybe completely accurate, but there was government bond yields at like 18%.
Right. So he's saying we could see in that second bout in 2024, something like double-digit inflation. And he says that's when the bond market will get smacked down again. And then he kind of gives his 10-year viewpoint of this kind of decade of roller coasters is what he describes it as. And we've talked about this with Stanley Druckenmiller. He has the viewpoint that 10 years from now, we could see the same price of the S&P that it is now in 10 years.
Hopefully he at least means that in real terms.
Right. Maybe. And so, and they both mention reasons why. They both use deglobalization as a reason why. And Felix Zulauf particularly mentions that in 1980, the most critical trading partner for all these countries was by far the U.S. But you look at it now, the most critical trading partner for anyone outside of North America and Western Europe is China. So we have this multipolar world. We have deglobalization. He said, we're the most, 3 years ago is probably the most we've seen like a global economy, interconnected economy than we'll ever see. So that means that we have safety of supply chains prioritized over efficiency and cheap supply chains, which means systemic inflation for the global economy. So he says that will cause a significant amount of roller coastering. And we've seen this before. So the two date ranges where we see like, let's call it more than 10 years of time go by and we just round trip to the same point.
Man, that's scary.
1929 to 1954. And the second period was 1966 to 1982. That was a 16-year period.
So systemic inflation on the supply chain, that actually makes sense to me as you like bring everything home. I think there's another systemic component, which is wages. Like there's less labor force.
Either aging or just optionally decline,
Right,
retiring early.
Labor participation is going down. But people are still hiring, so they're fighting for laborers, and that's increasing wages. And then you have rent, which we're like constrained on supply on housing, and what's the alternative there? You go homeless, like
right.
Those are systemic and sticky. So like I could totally see Felix Zulauf's thesis playing out where we're not out of the woods on inflation.
And he says expect central banks to respond like they always have, overreacting each time, maybe too slow to respond, too fast to respond, and you get this yo-yo effect. And why I think this is important, why I wanted to bring it up and talk about it as a group a little bit, is that there's been a rise in popularity of passive investing. Buy the market, buy the ETF, let it ride, and buy and hold these index funds. And I have a worry that I don't want us to see us do this and then 15, 16 years later end up basically with a 0%
flat
return. We're in our mid to late 30s. I don't think any of us want to be 50 years old and be like, well, I literally appreciated nothing over that
So
time
the way to play that then, if his thesis is correct, the way to play that is you ride the roller coaster up and then you sell it before it goes down and then you buy the dip.
Oh, that
and
sounds easy.
Yeah.
Wait, we just have to buy low and sell high?
But I mean, like that's different than the previous 12 years where you just ride the thing.
There has to be like rotation or allocation to various asset classes that changes probably over time, I think is what you're saying, right? Like we can't just buy stonks and just go away.
He kind of simplified it. He was like, listen, if you're a simple investor, then you need to know when to sell and just be in cash when these cyclical changes happen. Or if you're a more active investor, then yeah, you should understand that nature goes in cyclical motions and that sometimes you have to be net short and be a little more advanced.
Yeah, I think like how I'm framing in my mind is like, imagine that ETH pumps up to 2,700. Like you don't in your own mind be like, here we go again. No, you're like, no, now's the time to de-risk. Like, and always have that in your mind.
Yeah, let's talk about that for crypto, right? Because I think most of our audience probably cares about crypto.
I mean, that's what I'm thinking of is like if I'm going to barbell this with real estate and ETH,
yeah,
I want to know when I need to understand the cyclical changes of ETH.
And yeah, if you follow me on Twitter, I've been like chirping back and forth with Hal Press a lot, and like he came out after the CPI print with like, oh, I was told inflation would never moderate, and like it's not a question of inflation moderating; it's a question of like, what does that mean? Does that mean a recession? Do you want to hold cryptocurrencies going into a recession? I think not, but the truth is, like, I don't think we've ever had crypto for a recession. True. Other than COVID, which wasn't really that was just like a massive credit blowout.
2008 was
that was the birth of Bitcoin.
Bitcoin was birthed in 2008.
Like, we've never seen what this asset class does through a nasty recession, right? So the idea that you are going to just buy ETH at 1,000 or 1,200, 1,300, and just be like, I'm all in now. Now we're just going to go back up to 10. I forget about it. That might not be true. You might get a good trade out of this. Yeah, it might go to 17 or 2,000 or 25 next year. Sure, why not? But like, it might go way back down again. It might go lower. It might go lower than it did in the summer. And you have to have that in the back of your mind. And I think the place you want to really be aggressive is after the liquidity gets turned back on. Not after they stop like just punching everybody in the face, right? But after, they what does Darius say? After the ambulance is already on its way.
Right, ambulance sirens is what you're looking for.
Well, buy when there's blood in the street, buy when there's a catalyst to come and clean it up. And I think that's when you want to buy crypto, because I think crypto it's a liquidity trade. You're trading liquidity as much as we are making up all these magic reasons why this coin's going to go up, and it's just like liquidity driven narrative. So you need to know where in the cycle you are for that. And I think it's fine to nibble here. I have a little bit here in case I'm wrong. I certainly could be wrong, but I'm not like overly allocated here because my base case is we go recession, we have a credit event. You don't want to be all in crypto going into a recession, going into a credit event. That's just like how you get absolutely wrecked and you become like a forced seller. You want to be patiently waiting there with your bags of cash and then just come by and just go shopping. And that's kind of where I'm at. Now, I think the Bitcoin is like an interesting longer term. Let's put aside all the security, let's not have that discussion. Let's assume it works as intended. I think it's an interesting asset over the next 10 decades if like what Felix is saying kind of works out, because I think the government is just going to be forced into this. They have to ultimately choose between like the currency or defaulting on the debt at some point. Like we're ultimately going to have that decision. They're obviously, I think, going to monetize the debt. They're obviously going to pull the release valve on the currency. I think that's when it makes sense to have like these sort of fixed value, fixed supply digital assets, rather. And if you believe in a world where, as he says, like these other countries like China and Russia and the countries that are in line with them are going to start like eschewing the dollar and putting more of their value in commodities, in real stuff, I think you can argue that some of that value might go into something like Bitcoin as well. If not like a literal government buying it, but some of that like philosophy kind of.
So you just made an important point. I think that was one of the key things he said is that because the U.S. has weaponized the dollar with sanctions and whatnot, and because we now have this multipolar world, those other concentrations of power will use fixed and hard assets as a reserves, not necessarily U.S. treasuries in the future. He says the 2020s are about this shaking ground of what is thought of as like valuable in reserve currency, and maybe 2030s is when there's maybe some actually change. So I think he recognizes this is a very potential long and slow process. He understands that there's not very many currency alternatives. So he thinks commodities, oil, and yeah, I agree. You could see digital assets hopefully lumped into that. I kind of like take this last year. I mean, I think we all joke that we've read more and talked more about inflation and liquidity than I ever have in my life as being an investor. But this could be a blessing because if we are entering this decade of like roller coastering, I think those are the two things you kind of just want to have a feel for to try to understand when does liquidity cycles change, why would the liquidity cycles change, and most importantly, understanding what are the leading indicators of each. Obviously, it's not a science, but like I think these conversations we've been having, I feel a little more confident in maybe being able to detect it. We'll see. So yeah, I think that's just a change, a mind shift that we might have to consider a very high probability for the next 10 years.
So what do you think, like at a high level, like if we just zoom out really high level, the sort of like asset allocation and rotation looks like according to his theory, right? It sounds like it would be you buy bonds now.
For a trade.
Yeah, for a trade, longer duration stuff. If we go into some sort of credit event like recession or something, I don't know. The other side of this coin is that like bonds went to hell during COVID, right? You definitely lost money during that crash. That was a liquidity crunch. But let's assume it's just recessionary. I guess you could say you sit on a lot of cash, you buy bonds. Recession comes, your bonds go up in value. But now the presumption is that the banks all come in, they inject the system with liquidity again. Maybe the 30-year goes back to 1%. And then they just shoot everything full of like juice again, and then we pile back into risk assets. Presumably, this would be the point too, though, where you want to add some commodities to your portfolio. Commodities typically aren't going to do well in a recession because demand goes down. But like I'm assuming, like when this,
What about gold?
I think gold is different because it's not like something that's supply demand in the economy. But I think that you would want to buy gold at the bottom here because then if what he's saying is going to happen, the money printing starts at that point, then that's probably where we see gold maybe have its day.
I'm questioning the long bond thesis still, to be honest. Like I don't see that playing out in the way that you do clearly, unless you're playing like a much shorter time horizon than I am.
Well,
like
you're trying to get ahead of interest rates going down, right? Because that's when you make money off bonds. When interest rates are higher and then they go down, the value of the bond goes up, right?
Yeah, or capital that has to be somewhere. Like there's a lot of capital that can't sit in cash. It might be in equities, and it rotates to longer duration.
Okay,
like bonds.
yeah, I guess that makes sense. But like obviously, you would just continue to ladder on 3 month after 3 month at a higher rate than you would go long to 10 or 30 year or 20 year. When it's inverted like this.
Well, if you think the 30 year is gonna like drop 250 basis points next year, like really really quickly, then you would make a lot of money actually just buying TLT because just the price. You'd make more money from the price appreciation than the coupon payments.
And that would be like in an actual recession, then that would happen.
Yeah, and then you'd be flush with a bunch of cash.
But if you're buying that now, the TLT now, you're like betting on recession in sort of like first half next year.
Or basically any time next year, I think you're good.
I think like the way that I see it is like the economy is going to be surprisingly stronger than we imagine. We're not going to get an actual recession until later.
I thought that until Tuesday, and now I kind of feel like there's a lot of cracks.
Felix says middle 2 quarters, mild recession. But he warns that a mild recession doesn't mean that stocks can't take a hit.
Right.
Because earnings will go down because of that, because of slowing. And so he also mentions that, the U.S. is particularly strong. Europe, Asia, not as strong, and that the S&P, something like, I forget the exact number, maybe 50% of the earnings. I wrote down the notes for us, but something like 50% of the earnings of the S&P 500 come from those non-U.S. countries. So they're particularly vulnerable to earnings declines. Maybe to start to wrap this up and kind of put a bow on it here shortly. Dylan LeClaire, he's a Bitcoin boy on Twitter, but he posted this screenshot. I don't know when it was. I think it was today. And it was some other person in the comments, and the person says, "I don't know why people complicate things. Fed tighten, you tighten. Fed sell, you sell. Fed spending, you spending. Fed balling, you balling." And I thought it was like, well, I guess, yeah. I mean, if we're just trying to time these like big cyclical moments,
why do we even have a podcast?
Yeah, why don't we just leave with that and just write a blog post and then
Don't fight the Fed.
Yeah. So anyway, I thought that was a a good maybe summary. But yeah, if you guys want to add anything else before we tie it off.
Armand, are you just shell shocked by this? Are you just weighed down by the weight of the financial chaos that sits before us?
No, not way down.
Just thinking about Messi.
Yeah, mostly.
That's what I figured.
Yeah, I'm in prayer. I'm just constant prayer mode until Sunday morning.
He's charging his battery for the next episode. He's gonna come out swinging, and I look forward to it. Any parting thoughts, boys? All right, cool. That was a nice bow. I should have just let you wrap it there. Honestly, I don't know why I'm still talking. I ruined your bow.
Yeah, I did that last. I did that last time. I ruined the last bow. All right.
Thanks, guys. Bye.
Adios.
Bye.